Hello, in this video, we'll be talking about stock splits. We see here a piece of pizza, and guess what? You can buy one slice of pizza for $2, okay? And what happens if I tell you, oh, now you can get two slices of pizza? Would you pay more for this slice? No, because you're still getting the same amount of pizza. So in this situation, you say, well, then those two slices should be $1 each, and I can still buy it for $2. Now, why am I showing you pizzas when we're talking about stock? Because this is the concept of stock split. You're doubling the amount of pizza slices you have, but you're cutting the price in the same quantity. So let's talk about stock splits. Why do they happen? A stock split happens when, let's look at the example. It's when a company's share price is $100 and the company might issue, let's just call it for now, a 2-for-1 stock split. And so the holder of a share, right, one share, now that shareholder has two shares, but instead the new share price after the stock split will also split in half. So now they have two shares at $50, whereas before they had one share for $100. But ultimately, they have the same value and the same ownership in the company. So why do companies initiate stock splits? Typically, it's to reduce their market price. A lot of companies, when where their share price gets really, really high, and it's too high for the average person to, buy it, then they'll issue a stock split so that the per share cost will go down and more people will buy it. So it increases the stock's marketability. Apple did that in 2014. Apple has done many, many stock splits actually, but in 2014 they did a 7-for-1 stock split. I think Tesla in 2022 they did a 20-for-1 stock split just because the price gets so high. When you have a stock split, when just like I said, you have the same number, you have nothing has ultimately changed. Just like when we do a stock dividend, if you look at the previous video about stock dividends, economically, nothing that you have changed. You might have more shares, but they're worth less. So no journal entry is made for a stock split. And so what happens in the stock split, there's no journal entry, but the number of shares, issued and outstanding will increase, but the par value will decrease by the same amount. So by same ratio. So, and when a stock split occurs, all the records referred to previous amounts have to reflect a new amount. So when you have a stock split, the number of shares issued and outstanding will change. Let's just say we have a 2-for-1 stock split. They will double, and then the par value has to be cut in half. So, and all the records refer to that, to any shares outstanding and issued and outstanding and the par value, they have to reflect the new amount. Now, reflecting the number of shares issued and outstanding, changing that is not really that cumbersome, but to change the par value on a stock is very and requires a lot of manual labor to change that. So oftentimes, in order to avoid changing the par value, instead of having a stock split, the company will issue a one stock dividend, and that's effectively going to be a stock split in the form of a stock dividend. So, and we'll go through that in a little bit. So back to my pizza drawings here. What happened is this is a 2-for-1 split. You're going to get now two slices of pizza for this, when beforehand you only had one, but now we're going to split the price, right? So what happens is this is a 2-for-1 split. So you're going to take what you had originally, the number of slices, which we'll say is the number of shares outstanding, and you're going to multiply it by 2/1 because it's a 2-for-1 split. And now you're going to have two slices or two shares. At the same time, you have to reduce the cost of that one slice of pizza also. And so you're going to take the $2 and you're going to divide it by 2/1. Or you can also say multiply by the reciprocal, right? So because divide by 2/1 is the same as multiplying by 1/2. So we're going to split our price by 2. So imagine the price here is actually the par value. And so we're going to split the par value. We're going to divide the par value, and we're going to decrease the par value, increase the number of shares. And here's kind of a visual. If you had here a $20 par value common stock and you had 100,000 shares and you had a 2-for-1 split, then the new shares would increase, the number of shares would increase by 2, right? You multiply by 2. Think of the shares as your slices of pizza. But then the cost, which is the par value. So it's not the market value, and it's not really what we paid for the stock. We're just going to change the par value. We're going to divide it by 2/1. Now, when you have 2-for-1, it's really easy to conceptualize. But let's talk about what if we had a 3-for-2 split. So now for every 2 shares that you hold, the company will now issue you 3 shares. They're going to split into 3. So how do you do that math? Well, our number of shares, we're going to increase them. So we're going to multiply them. This is a 3-for-2 split. So we're going to take the 100,000 times 3/2, which will give us 150,000 shares. And then the the par value has to be divided by 3/2, which will be $13.33 per par value. That's going to be the new par value when you have a stock split. Back to my pizza, the same example, right? This is a 3-for-2 split. I had 2 slices, now I'm going to get 3. So I'm going to multiply by my number of slices or my number of shares, multiply by a 3-for-2 split. So now I have 3 slices, and my cost is going to be reduced per slice. So I'm going to take my cost, which is my par value, and divide it by 3/2, which is the same as multiplying by 2/3. So the dollar amount is the par value, the slice amount is the shares. So I'm just putting here, so if it's easier for you to kind of visualize or understand the concept, it's right here. If this doesn't make sense to you and the other way I presented like this makes more sense, then just whichever one is best for you, that's the one you should keep in mind. Let's go through an example. On June, this says problem 3, but this is our first example. On June 30th, Sharper Corporation stockholders' equity section of its balance sheet appears as follows, which is right here, before any sort of stock dividend or stock split. Sharper decides and immediately distributes a 3-for-2 stock split. After the distribution is made, you need to prepare this updated shareholders' equity section and compute the number of shares outstanding. So what do? Let's look at the number of shares after the split. So if we look up here in the shareholders equity section, it says 120,000 shares authorized. That is not the number of shares that they have sold and are remaining outstanding. This is the number of shares that they're authorized to issue over the life of the corporation, and this is on their corporate charter. So the number of shares that are issued and outstanding is 50,000. That's what we're going to increase. So it's a 3-for-2, right? It's a 3-for-2 stock split. So I'm going to multiply my number of shares by 3 divided by 3/2, that fraction. And I get my new number of shares outstanding after the split is 75,000. I want to note that it says the new number of shares outstanding. It's also the number of shares issued and outstanding will both increase to 75,000. Let's look at the par value. The par value we're told is $10, right? And we're going to multiply by the reciprocal of the stock split ratio, or in other words, we're going to divide it by 3/2, which is the same as multiply by 2/3. And so our new par value after the split is $6.67. And let's look at how my new shareholders equity section looks on the balance sheet. So notice I have common stock, paid in capital, and retained earnings. Everything, all the numbers are the same, right? My common stock is 500 still. My paid in capital is still 200 and my retained earnings 660. So my numbers on the total numbers on my shareholders equity has not changed, but right here, this has changed, right? Because now I have a new par value. It says my par value is $6.67, whereas earlier, before I made the stock split, it said $10. And now my new number of shares issued and outstanding is 75, whereas before it was 50. So when you have a stock split, there's no journal entry required, but there are things that need to be changed. So as I said a little while ago, if you do a stock split, the par value changes, right? The number of shares outstanding, but the par value reduces in a regular stock split. And changing that is just very cumbersome and very expensive. Like all the records, or whether it's printed electronic, have to be changed to reflect the new par value. So it's just a lot of work. And so to avoid changing the par value per share, a company can actually, instead of doing a stock split, they can do a stock split affected in the form of a stock dividend, which is what it says right up here, or it's just really known as a stock dividend. And in that case, the journal entry, that does require journal entry, because we've learned from a prior video of stock dividends that does require journal entry. However, the journal entry, what it really does is just a reclass between your paid-in capital and your common stock. So what you've done is you've issued, right, 100 million more shares. So you increase your common stock by the number of shares times par value. So you credit your common stock. And usually with a stock dividend, you would debit retained earnings. But for the most companies don't choose to do that when they're doing a 2-for-1 stock split that's in effect a stock dividend. They will debit their paid-in capital in excess of par for the same amount. However, there are certain companies that can choose to record it the way we've seen it before, which is when we credit that common stock for the additional $1 per par multiplied by $100 million, they will debit the retained earnings. So FASB is kind of vague, right? The accounting guidelines are vague in this regard as to how you have to record this stock dividend that's really more like a stock split, but some companies will choose to debit the retained earnings. Here's the disclosure from Tesla. Tesla Inc. announced today that the board of directors has approved and declared a 3-for-1 split of Tesla's common stock in the form of a stock dividend to make stock ownership more accessible to employees and investors. And so basically it just says that each stockholder of record as of this date will receive a dividend of 2 additional shares of common stock for each then held share. And this is when they're going to be distributed after the close of trading on August 24th. And I said earlier that Tesla had a 20-for-1 stock split. I think that might have been 2020. And then they had this 2-for-1 stock split in 2022. So they've had stock splits pretty close to each other. So we've talked about stock splits, and usually that's when a company's share price is really high and they want to reduce it so it's more accessible for people to purchase. But there's a concept called reverse stock split, and that's actually just the opposite. It's when the company decides to decrease its number of shares. Again, no journal entries is necessary because it is a stock split. But when you decrease the number of shares, in theory, your market price per share will increase, and it's usually done by companies that are really struggling and they really need to increase their stock price. Oftentimes it's because they don't want their stock price to become so low that's actually delisted from the market exchange. And so these reverse splits are not rare. especially when the stock market takes a downturn and companies need their stock price to be higher. So here's an example. After a 1-for-4 reverse stock split, 100 million shares of $1 per share would become 25 million shares at $4 par per share. So in this situation, the reverse, the number of shares gets reduced, but the par value gets increased. Now, typically when a stock dividend or a stock split occurs, ultimately there's going to be shareholders that are going to be entitled to a fraction of a whole share. And so oftentimes, instead of issuing a fraction of its share, like, 0.3 shares, the company will actually pay out cash to the shareholders for that fractional share. Let's look at an example. If a company declares a 25% stock dividend or equivalent a 5-for-4 stock split, so basically for every 4 shares, the shareholder would now have 5 shares. A shareholder owning 15 shares would be entitled to, they should say, an additional 3 3/4 shares. So that's just how the math works out. When you take 15 times 0.25, it's going to give you 3.75 or 3 3/4. So if the market price at the time they declare this stock split is $12 per share, the shareholder would receive the 3 shares that are listed right here, those 3 shares. But for this fractional share, this 3/4, they would get 3/4 the amount of $12, which is 9, right? So 9 times 3/4, 12 times 3/4 is $9. So they would get 3 shares plus $9 for that fractional share. Let's do a concept check. And this is more just how to figure out a roll forward of retained earnings while calculating stock dividends. The following data were reported in the shareholders equity section of the Brandon Industries comparative balance sheets for the years ended December 31, 2026 and 2027. So if common stock, paid in capital, and the actual retained earnings balance. During 2027, Brandon declared and paid a cash dividend of $45 million. The company also issued a stock dividend. No other changes occurred in shares outstanding during 2027. What was Brandon's net income for 2027? So I'm just going to write this here. Our formula for retained earnings is our beginning retained earnings plus our current year net income less any dividends, right? Any dividends paid is a reduction. And then we have our ending retained earnings balance, okay? So we have to fill in the blanks of what we're given in this problem so we can get to what is Brandon's net income. So this, we're solving for this second row right here. Well, let's figure out all of our dividends that were paid, right? Because that's going to reduce our retained earnings. We know we have cash dividends of $45 million and that the company issued a stock dividend. So the stock dividend is going to be, let's look. We started with common stock for 300 million and ended with 306. So our common stock went up by 6 million. Our paid in capital went up by 24 million, right? So, and this we know is due to a stock dividend because that's the only transaction that happened for shares outstanding. So besides the cash dividend that we're already told the number. So we're going to credit common stock for 6, credit paid in capital in excess of par for 24. And when we have a stock dividend, we debit our retained earnings, which reduces our retained earnings. So let's go into our retained earnings formula where we have our beginning retained earnings plus net income less our dividends equals our ending retained earnings. We're told our beginning and ending balance for retained earnings, 303.14. So we already have that piece of information. Now we just calculated this reduction in retained earnings because of the stock dividend. So we know that's a portion that attributed to this increase of retained earnings, right? There's things that make it go up and down. We know that there's a stock dividend that was paid for 30. There's a cash dividend that was paid for 45, which also reduces your retained earnings. So my net income is a plug of 89 million, and my answer is D.